Hello and welcome to another episode of Trust Issues from Kepler Trust Intelligence. Today I'm joined by Matt Bennison, Fund Manager of Schroder Income Growth, which has the ticker SCF. SCF is in the Association of Investment Companies UK equity income sector, but has a total return objective, which is to achieve income growth in excess of inflation, as well as capital growth as a result of that rising income. To achieve this, SCF blends companies with sustainably higher yields, with lower yielding companies offering much stronger future growth prospects. Now, I won't go too much more into the investment strategy because Matt will touch on that soon. But impressively, SCF has grown its dividend for 29 consecutive years, putting it among the AIC's exclusive list of dividend heroes. This record allows investors to capture the significant power of long-term compounding. Matt has been a named co-manager of SCF since 2017, having joined Schroders' prime UK equity team in 2015. He started his investment career in 2012 at Schroders Private Bank, which later became Cazenove Capital, where he worked for the Chief Investment Officer. Thanks for joining us today, Matt.
Pleasure. Good to be with you, David.
Could you just give us a bit of detail on SCF's investment process? What do you look for in companies?
In simple terms, we look for stock level mispricings. Now, what does that mean? We are bottom-up investors that do deep fundamental research, trying our best to understand the characteristics of a company, its management structures, its growth prospects, its margin profile, the strength of its balance sheet, to build a full picture and think about the paths the company could go down over the next 3 to 5 years. And then we try and put a value on that. And when, in our view, the intrinsic value of a company deviates materially from the value that the market's prescribing to it in the share price, we will buy the shares. But we'll also bear in mind that it's important for the end investor to create a diversified portfolio of mispriced opportunities to allow that stock level mispricing be the main driver of performance over time. We're not value investors, quality investors or growth investors. We are style agnostic, because we think, and all of those characteristics will be reflected in the portfolio. We try and avoid significant style bias because we believe that the sustainable growth prospects of a certain company can be mispriced and undervalued in the same way that a value investment can deviate significantly from its intrinsic value. Our turnover is low, typically 10 to 15%, so our average holding period of a company in the fund is over 7 years. And as a result of that, we do a lot of engagement with companies, with both boards and operational and exec management teams, because a long-term holding period lends itself to working with companies to focus on value release and extraction over multiple years, because these factors typically do play out over years and not months. So in the round, we look to create a concentrated but diversified portfolio of mispriced opportunities to deliver consistent performance for the end investor through cycle.
Sure. Now, working for a company such as Schroders, yourself and co-manager Sue Nofka obviously have a large team of UK equity analysts behind you that you can kind of call on. Can you talk to this depth of experience and how it helps you managing SCF?
Yeah, so as you mentioned earlier, I sit within what's called the Prime UK Equity Team. So we're a team of 3 individuals. It's myself, who you've already introduced, and Sue Nofka, who's worked for 35 years in the industry and at Schroders, so great experience within UK capital markets. And a third member of our team is James Goodman, who's worked at Schroders for almost 10 years and in our team for over 6 years. So that's the team that directly manages this product. But as you say, we have a wider UK equity community of around 12 investors, including us, managing money across the style spectrum. So we have value investors, quality investors, small and mid-cap specialists. And we all share our work on companies within the team. So it means that all corners of the market are covered from a range of perspectives. So that enables us to have that deep market knowledge and coverage to help us build our portfolio. But then outside of that, we clearly have the deep and wide resource of Schroders, and we will dip into that as much as we can. We have pan-European equity investors that look at UK companies but also provide wider geographical context. We have global equity teams, we have specialist healthcare teams, specialist energy teams, we have sustainable investment teams, we have real estate specialists, and we can call upon these investors and analysts informally, and we do this regularly, to help give a deep dive on a particular sector or tap into knowledge from across the regional equity spectrum to help build a fuller picture of an investment case. So we do have very deep resource that enables us to build our bottom-up research and help with our portfolio construction.
It would be remiss of us to kind of do this podcast and not talk about the UK's cheap valuations. But we have seen some more encouraging signs of life, with total returns from UK equities in the 12 months to the end of February of 18.4%. Now, that's obviously a strong result. Are you kind of more constructive on the outlook for our domestic market than you've been for a while?
Yeah, I mean, it's nice to hear you talk about and reference how strong the market's performed recently, David, because you are right. There are perhaps a few signs of life. I mean, because we've been talking about banging the drum for many years of the cheap valuations in the UK, to the point where it probably felt as if we were boring people at times. But, you know, when all is said and done, at the end of the day, the price you pay for something really does matter, and typically is the main driver of your future return prospects. And when that low valuation starts to be recognised and starts to move markets, the result can be very powerful. You know, we've seen an example of that in the Japanese market over the last 2 to 3 years, haven't we? Capital market reforms stimulate interest and a large re-rating of that market. So the result of that makes me quite optimistic, because we are seeing signs that the authorities in the UK are grasping the nettle to make the UK capital markets a more attractive place to invest. And there's a number of things that I also think are starting to be recognised that we've been talked about. You know, it might be the UK market by name, but it's not by nature. You know, only 20% of the revenues from businesses listed on the market are generated domestically, 80% are overseas. So you're getting international franchises at discounts in many cases to their global peers. There is more growth than you think in the UK, you know, shown by the long-term performance of the mid-caps. You know, over the last 25 years, the FTSE 250's outperformed the S&P 500. It's been weak more recently, but that's because there are a lot of, you know, hidden gems in the mid-cap area of the market with strong franchises, good growth prospects that have really delivered strong share price performance over time. I've touched upon capital market reforms, perhaps putting us in a better place. And also, I suppose it's important to remember the UK offers something different. You know, it's not to criticise the US market, because clearly it is full of a number of fantastic franchises that have delivered very, very strongly for shareholders, particularly in the tech space over time. But the UK does offer something different from a sectoral makeup. You know, since the end of 2021, for example, well, the European banking sector has outperformed the Magnificent Seven. You know, a total return of over 100% since the end of 2021. So you don't have to be a large tech company to have made people significant money over a multi-year time period now. And the UK does give you an exposure to sectors like that. And finally, we're seeing if public market investors won't reflect the attractions of UK PLC and share prices, then private and corporates will. And perhaps we'll talk in more detail about some of the M&A that we're starting to see coming into the UK market as a result of the share price and valuation opportunities. And as you said, the market was up 18% over the year to end of February. It's up over 50% over the last 5 years. And the compound return over 10 years of the market is over 7%. So if that's what bad looks like, then I'm quite excited about what good could start looking like going forward.
And picking up on that, you know, mention of M&A activity, we've obviously seen a lot of it within the UK stock market. Lots of companies have been on the receiving end of bids, some which have been accepted and some rejected. SCF has benefited from this to some extent, but I guess it's a double-edged sword. Do you see this as validation of the value within the UK market, and or do you kind of try to engage with companies that you own where you think the bids should be rejected?
I do particularly like that phrase, double-edged sword, that you've used there, David, because clearly it's no surprise that a market with a lot of what we believe are strong franchises trading at discounts to international peers and intrinsic value is going to see bid interest from both corporate and private equity buyers. And as you say, historically, M&A has been a reasonable contributor to the performance of our fund, as those undervalued franchises are the kind of businesses that we're attracted to. And more recently, you know, we've got kind of ongoing bid situation for Schroder, which is a holding in the trust, a healthcare real estate company. You know, one of our holdings, Anglo American, there was a bid that they rejected from BHP Group last year. And another factor that we're actually seeing is probably more pressure on companies within the portfolio and within the UK market from activist investors. You know, in the funds, companies like Johnson Matthey, Anglo American, Pearson, and Smith and Nephew all have activist investors looking to encourage boards and management teams to extract what they believe is undervalued opportunity from those companies. But you are right, as I say, on the double-edged sword, because it is a good validation of the opportunity in UK markets. But also, we've got to stand up for value for our clients here. And if we believe the bid is still at a significant discount to intrinsic value, we will be letting the boards know that and the management teams know that, and we will not be rolling over, because clearly there are a number of opportunistic bids out there because of the extent of the undervalue of UK equities. Because simply, if you've got an asset that you think's worth £1, it's trading at 50p, and a bid comes in at 60 or 65p, you shouldn't be letting it go at a 35-40% discount to intrinsic value. So we will be we'll be doing our best to fight for value. And like I said, the bulk of that is done in the background in engagement with boards. But also, we are where we strongly believe that an asset is being sold for too cheap valuation. We are happy to make the views public around that, because we're here to make sure we get a full and fair price for our end clients.
And we've seen also a noticeable increase in the number of UK companies buying back their shares recently. What do you kind of make of this trend, and can you talk us through the impact that it's had on SCF's portfolio?
Yeah, I mean, there has been a marked increase. 3 or 4 years ago, only about 20% of the companies on the UK market were buying back more than 1% of their equity in a year. Now that's about 45%, so it's more than doubled as a proportion. And that's actually a higher proportion than of US companies that buy back equity. There's slightly north of 40% of US companies buy back more than 1% of their equity each year. Clearly that's in many ways another validation of the strength of the valuation opportunity of the UK market, because it means the boards of UK companies are sitting around the boardroom table thinking that they've got surplus cash, looking at their shares, realising that they're cheap, and deciding that instead of paying a dividend or investing in a growth opportunity, that the best use of that cash is to buy back their own equity because they think it's cheap. And to give you a flavour from our portfolio, in the financial year that ended August 2023, 17 portfolio companies bought back shares, but then there was a big increase, and that was about 29% of the holdings. And then in 2024, there was a big increase to around 29 companies, and 60% of the portfolio buying back shares. So it's a good validation of the valuation on offer, and that the balance sheets are strong, and that corporates have surplus cash. However, it has at the margin made it harder to hit the income objective of the trust, because a share buyback is using money that perhaps at another point in the market cycle might go towards a special dividend. Now, in the round, that doesn't make a huge difference to the end investor, because it's all money that is coming back to shareholders and generating a return for them. However, when you have an objective to generate income from portfolio holdings and distribute that back to the end investors over time, from a pure dividend income perspective, it does make it slightly more challenging, because UK companies across the market return of the order of just north of 90 billion of ordinary dividends back to shareholders every year. In recent years, they've been conducting the best part of 50 billion worth of buybacks, so it's a broadly 50% top up to the dividend in buybacks. So at previous points of the market cycle, those would have been special dividends, and we saw that through COVID, through exceptional special dividends from mining companies that are not around anymore. So it has made income generation in its purest form more difficult, but it hasn't changed the attractions of the total return prospects of the UK market.
And how does SCF balance the need to provide shareholders with an attractive, sustainable and growing income with its capital return objective?
Yeah, you touched upon this in your opening remarks, because it does kind of touch upon the kind of the salient aspects of income fund management and some of the pitfalls that can come from that, because we need to make sure that we're not just attracted to yield for yield's sake, because that can lead you to being invested in a value trap. We have to really think strongly about the sustainability of those yields. So at a portfolio level, we make sure that we try and achieve a balance of companies with high but sustainable yields, perhaps of over 5%. These will be companies perhaps more mature in their industries, that don't have huge organic growth prospects, so they distribute the majority of their surplus cash back to shareholders every year, mainly in the form of a dividend, but we're seeing more buybacks there. So that helps us hit the objective of delivering yield today for clients. But then how do we think about delivering income growth tomorrow? That'll be balanced by a portion of companies in the fund with lower dividend yields, maybe 2.5%. But those lower yields are typically because companies are distributing a smaller portion of their surplus cash back to shareholders each year and retaining a more significant portion to reinvest into growth projects. It could be organic growth, it could be small bolt-on acquisitions. So in the round, the balance of that gives us a portfolio that has a modest yield premium to the index, but then an income stream that grows, and the objective of the trust is to grow that ahead of inflation, UK CPI inflation, through a market cycle.
Just to kind of finish off the podcast today, whereabouts in the UK market are you particularly bullish on at the moment?
Yeah, well, like you say, I mean, we've clearly talked about the aggregate attraction of the market, but and another area I mentioned earlier was, the banking sector, which feels very well underpinned at the moment. Banks spent 10 or so years post the financial crisis repairing balance sheets and doing that in a very low interest rate environment that wasn't very good for revenue and profit generation. We're now in a position where capital positions are strong, interest rates have risen significantly, so the profitability for picture banks looks much better. And as a result of that, the shareholder return prospects look good as well. These banks are returning 30 to 40% of their market caps back to shareholders in the form of dividends and buybacks over kind of 3 years in the future, broadly. And they're doing that from valuation standpoints that are still in the round below where they have traded kind of at mid-cycle points in the past. So we still believe there's probably more re-rating upside, but also good capital return prospects. Another one would probably be the utility sector, where there's clearly, particularly within the UK, an appetite to improve the UK's infrastructure, both power infrastructure, but also water infrastructure. But we have good exposure to power utilities. So that means that the asset growth of these companies is going to be strong in both nominal and real terms over the next 5 years of regulatory cycle. And the revenue streams are typically inflation linked, and they have good yield prospects as well. So good capital and income growth prospects from those sectors, I'd say. So they're probably 2 areas of the market. I talked earlier about the long-term strong returns that we've seen from the mid-cap area of the market in the UK, but there's been a big dislocation in the last 2 to 3 years where mid-caps have significantly underperformed large caps. So that says to us that there must be some strong selective opportunities in mid-caps given the valuations on offer. Because on aggregate, the dividend yield of the FTSE 250 is not that far off the yield of the FTSE 100 now, and that's quite rare in a historical context. So we can both get capital growth there, but also income to be a contributor to the portfolio. So we'll definitely be seeing selective opportunities as well there as well. And they're 3 areas that we're overweight. We're overweight banks, the order of 3%. We're overweight utilities, of the order of 2%. And we're overweight small and mid caps, the order of 8% in the trust.
Thanks for your time, Matt, today, and sharing your valuable insights with us.
Pleasure. Thanks very much for having me, David.
Now, listeners can find out more about SCF on the Kepler Trust Intelligence website, as well as through the Schroders website, which has some fantastic insight articles there too. We'll link to both of those in the video description. Thanks for joining us today, and we hope to see you soon.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorized and regulated by the Financial Conduct Authority.